Understanding the Mechanics of Fixed-Rate Mortgages, a comprehensive guide. When it comes to financing a home purchase, one of the most critical decisions individuals face is choosing the right type of mortgage. Among the plethora of options available in the market, the fixed-rate mortgage stands out as a steadfast choice for many prospective homeowners. In this comprehensive guide, we delve into the intricacies of fixed-rate mortgages, exploring their mechanics, advantages, disadvantages, and frequently asked questions to empower borrowers to make informed decisions regarding their home financing needs. Unveiling the fixed-rate mortgage. A fixed-rate mortgage epitomizes stability in an inherently volatile financial landscape. Unlike its counterpart, the adjustable-rate mortgage, ARM, which subjects borrowers to fluctuating interest rates, a fixed-rate mortgage offers a sense of predictability by maintaining a constant interest rate throughout the loan term. This stability extends to the monthly principal and interest payments, facilitating budgeting and financial planning for homeowners. The inner workings. 1. Loan origination. The journey begins with the borrower's application with a mortgage lender, wherein financial details are scrutinized and creditworthiness is assessed. Borrowers select from various loan terms, such as 10, 15, 20, or 30 years, tailoring the mortgage to their specific needs and financial capabilities. 2. Interest rate dynamics. At the onset, the interest rate is locked in, remaining fixed for the entirety of the loan duration. Opting for a shorter loan term often translates to lower interest rates, but higher monthly payments, while a larger down payment can secure a more favorable interest rate. 3. Repayment regimen. Fixed-rate mortgages typically follow a fully amortized repayment structure, ensuring the loan is fully retired by the end of the term if all payments are made as scheduled. Initial payments primarily service the interest, gradually transitioning to greater allocation towards the principal over time. 4. Supplementary payments. Homeowners have the option to expedite the mortgage payoff process and mitigate interest expenses by making additional payments towards the principal balance. Advantages and disadvantages. Pros. Payment predictability. Monthly payments remain constant, facilitating budgeting and financial planning. Stability. Shielded from interest rate fluctuations, borrowers are immune to payment hikes even amidst volatile market conditions. Refinancing flexibility. Borrowers can capitalize on lower interest rates by refinancing their fixed-rate mortgage, seizing opportunities for cost savings. Cons. Higher initial rates. Fixed-rate mortgages often incur higher initial interest rates compared to the introductory rates of ARMs. Absence of rate reductions. Absent refinancing, borrowers cannot capitalize on potential interest rate decreases as they would with adjustable-rate mortgages. Requirement for substantial down payment. Securing optimal rates may necessitate a sizable down payment, posing a barrier to entry for some borrowers. FAQs demystified. What is the average APR for a fixed-rate mortgage? As of spring 2024, the average rate for a 30-year fixed mortgage hovers around 7%. However, rates are subject to fluctuations based on prevailing economic conditions and borrower-specific factors. When should I consider getting a fixed-rate mortgage? Opt for a fixed-rate mortgage during periods of historically low interest rates or when seeking steadfast monthly payments conducive to budgeting, particularly for individuals reliant on fixed incomes or contemplating long-term homeownership. Are fixed-rate mortgages a prudent choice? Fixed-rate mortgages are advantageous for borrowers prioritizing payment stability and intending to reside in their homes for extended durations. While they safeguard against interest rate hikes, borrowers forfeit the opportunity to benefit from potential rate reductions without resorting to refinancing. In conclusion, fixed-rate mortgages offer a reliable avenue for homeownership, affording borrowers stability and predictability in an ever-evolving financial landscape. By comprehending the nuances of fixed-rate mortgages and weighing their merits against alternative financing options, borrowers can embark on their homeownership journey with confidence and clarity.